International investment appraisal is a really important chapter. International investment appraisal techniques with numbers, we're going to go through two methods, often comes up in question 1 of the exam. And the discussion areas, financing and risk in particular, also occur very commonly. So this is an important area to work through carefully and to practice questions on. In section 1 we're going to consider the strategic reasons that encourage companies to invest overseas. A convenient framework to use and an easy one to remember are the 5 C's. So you might invest overseas because of the effect on the company. By becoming much bigger, you create powerful economies of scale. Perhaps also there's something about the particular country that you want to invest in. This might be that they've got great local suppliers, or cheap labour, or access to government grants. It could be a huge variety of factors. It might be that you've got some key customers in particular countries and you want to locate close to them so that you can supply them in a timely way. It might simply be that in particular countries competition's weaker. And it might be for currency reasons, that if you're already selling a lot in the US, for example, well, if you invest there, then it creates costs, the cost of your factory. And that reduces the net amount of cash in dollars flowing back into the UK and helps to manage exchange rate risk. As with all these frameworks, they might be helpful, and they can sometimes be a bit restrictive, that there might be points that you want to make that seem to be relevant to a question that don't lie within the 5 C's. It might also be the case that as you try to apply the 5 C's, only 2 or 3 work for a particular question, in which case that's all you'll use. Let's apply them to a real example. In 2007, Tesco's opened their first stores in the US under the brand name Fresh and Easy. Let's try applying the 5 C's to this general scenario. Powerful impact on Tesco? Well, yes, the bigger Tesco is, the better the prices it will get from its suppliers. Wanting to be in the US? Well, it's a very wealthy market, it's a massive market, and there are good reasons to want to be there, even if not the precise explanations that we had in the table. Customer reasons? Well, perhaps not locating close to your customer, but certainly feeling that you understand US customers and their tastes aren't perhaps that different from UK customers. Weak competition? Well, the world's biggest retailer, Walmart, dominates the US market, but Tesco's felt there was a gap in the convenience store sector, and that's what they were going for. The final factor doesn't really relate to Tesco in any obvious way. As well as the strategic logic of investing overseas, you need to be conscious of the fact that risk is very high and that many overseas investments will fail. The indications are that Tesco's currently are having difficulty in the US. We can see this with an article on the BBC website. And this article indicates, if we just scroll down, that Tesco's trading profits, which you can see in the bar chart, are great everywhere apart from the US, although sales are rising. The jury's out, and the indications seem to be that Tesco don't perhaps understand the US customer quite as well as they thought they did, so they're trying to sell lots of pre-packaged food, which isn't necessarily going down that well. And they're finding it difficult to cope with Walmart, who are reacting very aggressively to this move into their sector. As well as these strategic risks, we've also got a very specific financial risk. The risk that if you've invested in the US and the dollar falls, then that will mean that all of the returns that you're getting from that investment will fall in sterling terms. You don't want to invest in an economy and then see its exchange rate decline. And before you invest, you'd want to look for danger signals that indicate that there is a real possibility of a fall in the overseas currency. And we're going to look at some of these signals in lecture example 1. In this example, we're going to imagine that we're thinking about investing in the US economy. Before we did, we'd want to look at projections for US inflation, because if US inflation is high relative to UK inflation, then that's telling you that what you can buy with a dollar is falling, the purchasing power of a dollar is falling, and over time that'll follow through onto the currency markets, and it will mean that a dollar buys fewer pounds. And that's the risk that we're concerned about. If interest rates in America are projected to be high, that is very likely to mean that US inflation is high, so this will probably have the same impact. Although it's fair to say that if interest rates are being held high for some other reason, some other economic reason, then this may not be true. If there's a balance of payments deficit in the US, then that means that you're buying lots of imports, and that means that dollars are flowing abroad. If there are lots of dollars sitting with currency traders as a result of US consumers buying, say, Chinese and Japanese imports, then over time those dollars will be sold, and as the dollars are sold, the value of the dollar will go down. If the US government is borrowing a lot of money, this can have exactly the same impact. A lot of US government debt will be bought by Chinese, Japanese and other Asian investors, and that will mean that lots of interest repayments are going to go abroad. Ultimately, the dollars being held abroad will be sold, and the value of the dollar will go down. You'll need to show some awareness of the things that can affect exchange rates over the long term. But the two key points were the first two in the example, and we're going to consider them in more detail now. The reason that inflation rates and interest rates are particularly important in forecasting exchange rates, is that they can be tested numerically, using formulas that are given in the exam. The way that exchange rates are quoted for this paper is that the currency on the left, we're looking at 1 unit of that currency. Country A here is the base currency, and country A's inflation rate goes on to the bottom of the formula. The other currency is currency B, belonging to country B. So you have to be slightly careful with using the formula, as we'll see, but we can forecast what's going to happen to the value of a unit of country A's currency by using this formula. And the way the formula will work is if country B has got higher inflation than country A, then country A's currency will get stronger. And this is called purchasing power parity theory. Let's take a look at it in the example. The lecture example is set up as two brief scenarios. The first line relates to requirement A and the second line relates to requirement B. Let's look at requirement A first. The requirement is for us to use some real data from 2007 to forecast the spot rate for the dollar against the pound, pounds on the left hand side, so this is for 1 unit of pounds, and to forecast the exchange rate using this data. So let's set out the formula. And now let's forecast for the next 3 years. The way the data is given, pounds are on the left hand side, so pounds become country A. So we're going to be multiplying by 1 plus country A inflation, so that's the UK, where inflation's 2.7%, and 1 plus country B inflation, where country B must be the US. So starting from 1.95, I'm going to multiply by 1.021 over 1.027, and then I'm going to do it again, but starting from 1.939, and then 1.917. Time 0 is here, using real 2007 data. So we'll be using it to forecast that in 2010, a pound would be worth about $1.92. In fact, if we look at the value of the pound to the dollar in 2010, it was closer to 1.6. And this just makes the point that exchange rate forecasting is incredibly difficult. And while you have to be able to use these formulas, you should appreciate that they're very approximate. Another way of putting this information that has been used in the exam is by simply giving you a trend. So you might be told, as a trend, that the pound will get 0.584% weaker per year. And if you've been told that here, then you would have taken your first exchange rate of 1.95 and you would have reduced it by 0.584% because it's an exchange rate to the pound and the pound's getting weaker. So just to show that for 1 year ahead, so 1.95 is the value of a pound, reducing it by 0.584% gives us the same forecast of 1.939, just another way that the information might be presented. Alternatively, you might be told that the dollar will be changing in value. So if you were told here that the dollar will change in value by 0.587% per year, then you take the exchange rate, which is quoted to the pound, and you'd multiply by 1 over 1.00587. And that will give you 1.939 again, but just another way of guessing there. And we've had to make the adjustment of multiplying by 1 over 1.00587 because the exchange rate that was moving was the dollar, but the exchange rate that's quoted for here is the pound. Now let's have a look at part B. In part B, the exchange rate is given to the euro. So in terms of the formula, the euro becomes the currency on the left-hand side, so that becomes country A. And country A inflation will be inflation in Europe. So 1 plus that is 1.021. And then country B inflation will be the UK, 1.027. So we'd start with the exchange rate of 0.67, and then we'd continually multiply by 1.027 over 1.021. So starting from 0.67 and multiplying by 1.027 over 1.021, you should be getting that sort of trend. Being able to forecast exchange rates is important for overseas investment appraisal, as we'll see in a minute. Going back above the example, going back to section 1.3, there's another set of formulas that you can use to forecast exchange rates. They look virtually identical. The only difference is that it uses interest rates instead of inflation rates. And we would generally assume that interest rates are only different because of inflation anyway. So this is effectively the same approach. It's called interest rate parity theory, and it works in exactly the same way as we've just seen in the example, but instead of dropping in inflation rates, you're going to put in interest rates. We can now go on and do some project evaluation. We'll start at a fairly basic level and then we'll build in some complexity. You need to be aware of two approaches for evaluating international investments. We're going to use lecture example 3 and lecture example 4 to go through these. And after we've completed lecture example 4, we can compare the two approaches. The first approach involves taking cash flows from an overseas investment, in dollars perhaps, including US inflation, and then forecasting the exchange rate using one of the techniques that we've looked at earlier to convert everything into pounds. And then once everything is in pounds, discounting as if it was a UK project. And this is lecture example 3. Okay, so the first thing that we expect to do is to convert our cash flows into nominal terms and to make sure that they're after tax. But this is done for us in this example, where the cash flows that are given are already nominal and post-tax, and they're in East Asian dollars. So we want to be able to convert them into pounds, and that means we have to forecast the exchange rate. We've got information in parts A and B to forecast the exchange rate using inflation. And we've done that in previous examples. Once we've forecast the exchange rate, we should be able to convert everything into pounds, and then we're going to discount at 16%, which is the return that's expected in the UK on this project. Now I'd like you to pause the presentation there and to have a go at this. You've got an outline of the 3 steps to go through at the just above the lecture example, and the key part of the example, which is exchange rate forecasting, we've done before. Okay, so we can lay out the cash flows without any adjustments, and then we have to start on the exchange rate forecast. The exchange rate is given to the pound, so in terms of the formula, the UK is country A. So country A's inflation, the UK's inflation, is 5%, and country B's inflation, East Asia inflation, is 3%. So I'm going to take the spot rate, and year after year, I'm going to multiply by 1.03 over 1.05. And that gives me an exchange rate of 1.9619, and if I multiply that by 1.03 over 1.05, and continue to multiply by 1.03 over 1.05, I show a steady forecast predicting that the pound will get weaker, which makes sense because inflation is higher in the UK. Then I can convert everything into pounds, and I've got to be slightly careful as I do this. If there are $2 to the pound, there are always more dollars than pounds, which means that I need to be dividing to get my pound equivalent, and doing the same for the other years, and then discounting at 16%, which was the return required in the UK, and then I can multiply the pounds figures by the discount factor to get the present value. And that should give you an NPV of about 272 positive in pounds, so it's an attractive project. Just a quick look at the exchange rate forecast. We're forecasting that the pound will get weaker by about 2% per year, and that 2% per year is the differential between the 2 inflation rates, and that 2% is good news. If the pound gets weaker, that always sounds like it's going to be bad, but what it means is the East Asian dollar is getting stronger. And if the East Asian dollar is getting stronger, and that's what you've got your cash flows in, then this is beneficial to the project. So we've built that good news in, and this is an attractive project. Now let's have a look at the second method, and then compare the two. Okay, so now looking at the second approach. With this approach, we have the same first step. So we make sure that our cash flows in dollars include inflation and they're post-tax. We then imagine that it's an overseas project, let's say an American project, and we discount it using an American cost of capital. And that will give us an NPV in dollars. Because that's a present value, we use the spot rate to convert it into pounds. This approach looks easier because we're not doing an exchange rate forecast. However, when we need an American cost of capital, this is something that you might have to calculate. One way of calculating it is to compare the spot rate that you've forecast in a year's time to the rate today. If these are different, it'll be because of inflation, and we can build that inflation difference in to the overseas cost of capital, because the overseas, country B, cost of capital will only be different from country A's cost of capital because of inflation. That'll become clearer as we look at some numbers. So let's look at lecture example 4. We'll do this one together. The details in lecture example 4 are exactly the same as in the previous example. And what we hope to show is that you can use this second method to get the same answer that we've got in lecture example 3. With this second method, we're going to take the cash flows as they're given, and we're going to discount them as if they're an American project. Sorry, here an East Asian project. We can't discount them at 16% because that's the return that you'd want in the UK. And in the UK, inflation is higher than it is in East Asia. So in East Asia, they'd be happy with a lower return. We can use the formula, which is given, to estimate the East Asian cost of capital. We know from lecture example 3, when we did the exchange rate forecast, that the spot rate in 1 year's time is 1.9619. Compare that to the spot rate of 2 and you get 0.981. You also get 0.981 if you put 1 plus inflation overseas over 1 plus inflation in the UK. This 0.981 shows you the impact of inflation rate differences, and we can use it to forecast the cost of capital overseas. So now looking at the left-hand side of the formula, we know that the cost of capital in the UK is 16%. And what this formula is telling us is that 1 plus the cost of capital overseas divided by 1.16 equals 0.981. So I can forecast my cost of capital overseas by multiplying both sides by 1.16, and that's telling me that 1 plus the discount rate overseas is 1.138. So my cost of capital will be 13.8%. So now I can do my NPV. I'm going to discount the cash flows at 13.8%. In the exam, I definitely round up to 14 and use the tables. But I'm going to discount it exactly 13.8% here because I'm going to try and show that it gives almost exactly the same answer as the previous method, so I'm trying to be as precise as possible. So putting in the discount factors at 13.8%, okay, so I've calculated these using the formula 1 plus r to the power of negative n. And then applying those discount factors gives me a present value and a net present value. Still in dollars though. So the NPV is 544. That's in dollars, and at the spot rate of 2, that's going to convert back into pounds and give me a positive NPV of 272, which is the same answer that I had before. In the previous approach, I had 2% per year of good news because the exchange rate overseas was strengthening. Here I've got 2% of good news because every year I'm using a cost of capital that's about 2% lower. So the two methods should give the same answer. In the exam, you need to be able to use both. In section 2, we look at some of the risks involved in investing overseas and how they might be managed. One key term in overseas investment appraisal is political risk, and this is the risk that an overseas government does something to harm your overseas investment. For example, they might put up local interest rates or local taxes. Even at the extreme, they might seize your assets, but if that was a risk, you probably wouldn't be investing in that country. Political risk can be mitigated by using overseas debt finance. If the debt is fixed rate, then you're immune from interest rate increases. And if you've got debt finance, it minimises your taxable profit, which means there's less exposure to corporation tax rises. And one way of getting overseas fixed rate debt finance is by using Eurobonds, which is a very popular source of finance, and there's an article on this in Checkpoint 3. It's case number 8. Typically, Eurobonds are issued by large companies. Recent examples include Volkswagen, the Disney Corporation, and Cadbury Schweppes. All that they're going to do is to borrow in a foreign currency using the bond markets. The bond markets are organised by merchant banks, and the merchant banks are going to issue bonds on behalf of the company and sell them. Bonds are often cheaper than bank loans, as we saw earlier in the course, and one of the reasons for this is that bonds can be sold by investors. Eurobonds, because they're issued by companies with excellent credit ratings, are normally unsecured and carry no debt covenants. And if you issue Eurobonds, you end up with a long-term liability in an overseas currency which you can match against a long-term investment, again reducing exchange rate risk. Lecture example 5 gives you an idea of how this topic might be examined. It follows from the previous couple of lecture examples. If we're investing overseas and discounting at a UK return of 16%, concern might be expressed that using your normal cost of capital isn't appropriate. And it might be argued that if you invest overseas, business risk is higher and a higher cost of capital should be used. Especially as we're told that this professional institute intends to use overseas debt finance to fund the project. You're given a table to discuss the concerns of the board under 2 headings. First of all, let's think about the impact on business risk of investing overseas and whether it should be reflected in a higher cost of capital. So we could argue that business risk will go up if we invest overseas, and it will go up because there is potentially higher political risk, and there's certainly some exchange rate risk that you wouldn't have in a domestic investment. However, there's also a counter-argument which says that because you're investing outside the UK, then you're building an international portfolio. So if the UK goes into recession, the impact on this company will be mitigated by the fact that it's got an international portfolio. So what is the impact? Well, it's questionable. There isn't a correct answer here. So should the cost of capital be higher? There is possibly an argument for having a higher cost of capital for evaluating overseas investments, and many companies do, but it's very debatable, and it's acceptable just to use your UK cost of capital to evaluate overseas investments for that reason. Now let's look at the right-hand side. If we use debt finance, then this is effectively a question about capital structure, and we could use Modigliani and Miller to come up with a few points. Modigliani and Miller would suggest that you maximise your use of debt finance, and the reason for that is that you'll get tax savings. Now you could argue that a professional institute may not be a for-profit organisation and therefore may not get these tax savings. If that's the case, then we'd be looking at M&M theory with no tax, and in that case the use of debt finance has no impact on the cost of capital. So that's potentially a conclusion that we could come to here, and in that case we could say actually using 16% as your cost of capital is fine, Even if it's debt financed, it won't have any impact, and the impact on business risk is debatable. The other key category of risk is translation risk. If you invest overseas, you'll have assets, perhaps in dollars. On your balance sheet date, you convert them back into pounds. If the dollar's got weaker, then you convert them into pounds, and it's a lower value. And you will probably write the difference off to reserves, but in that case, your gearing, debt to equity ratios, will get worse. That might have serious consequences. If you breach the loan covenant on gearing, then you may have to repay your loans. To manage the risk of gearing being affected by exchange rate movements, you can use debt finance. So wherever you're using debt finance, we're going to use debt finance in the overseas currency, not in the local currency, and by doing so we're going to minimize translation risk. We'll illustrate this in example 6. In lecture example 6, it's now November 20x7 and we're just coming up to our balance sheet date, 31st of December. We're given a forecast balance sheet. Note that this is a French company, so the balance sheet's in euros. The forecast doesn't take into account the fact that we're going to invest in America $1,000 million of assets. We're worried that the dollar will devalue or that the euro will get stronger. And the exchange rates given show this possibility. The value of the euro might go up from 1.1 to 1.4 by the end of the year. And the requirement is to prepare a balance sheet forecast that's been revised to take into account the two exchange rate scenarios. First of all, assuming that we borrow in euros to fund our investments in dollars, and secondly, showing the benefit of funding our investment with dollar debt. If we use euro debt, then at today's exchange rate we'll be borrowing 909 million euros. And that means that our floating rate debt will go up from its current level of 2,000 million euros to 2,909. The value of the assets will go up by the same amount, to 14,909. Shareholders' equity is unaffected, as assets and liabilities have gone up by the same amount. And if you add up the equity, floating rate debt and the current liabilities, they will come to 14,909. We've got assets of 14,909, and it's been financed by equity, floating rate debt and current liabilities. That's the situation if the exchange rate does not change, but if it does change, we're going to see a different picture. The floating rate debt will be unaffected because we take out the debt in euros and we've borrowed 909 million euros. But the assets that we've acquired are in dollars. And if the exchange rate moves, then those extra assets, now when I convert them back at the new exchange rate of 1.4, are only worth 714 million euros. And so my assets will be 14,714. So my assets have gone down in value from 909 to 714, which is a reduction of 195. And that's going to come off the value of the equity. So the value of the equity will now be 5455, and that's what we don't really want to happen. And what we've seen here is that a devaluation of the dollar has caused a fall in the book value of our equity. That's going to affect our gearing ratios, and that's a good illustration of translation risk. A fairly simple way of dealing with this is to borrow the money in dollars. And if you take out a dollar loan, it'll mean that you're borrowing $1,000 million and you'll convert that into euros at whatever the exchange rate is. So if the exchange rate's 1.1, then the debt will be worth 909 and your total debt debt will be 2,909. And if the exchange rate's 1.4, then your debt will be worth 714, and your total debt will be 2714. Your assets will be worth the same as they were worth in Part A, and your equity will be the balancing figure, and equity will be unaffected because assets and liabilities have been affected in the same way by the exchange rate movement. So there's no change in the value of equity, there's no translation risk. This sort of example has come up in exam questions before. In section 3 we look at a number of complications that you might come across as aspects to an exam question on overseas investment appraisal. The first is the concept of opportunity cost. Remember that if you invest overseas, it may mean that you stop exporting. And if you stop exporting, then you're going to lose the profits that you were making, net of any UK tax. Also, you'll have to deal with overseas taxation in many questions. Now, in reality, there are different ways of dealing with overseas taxation. The key point is that you show awareness that if you've already paid tax overseas, you're very unlikely to be paying it at the full rate again in the UK. Most governments give a tax credit for foreign tax paid in some way. And we'll have a look at lecture example 7 to see how you might sensibly deal with this issue. In lecture example 7, we're looking at a company that's made an investment in Ireland and it's expected to deliver pre-tax cash flows of €1 million in year 1. For simplicity, we only look at year 1. We can imagine that there'll be other years as well, but we'll deal with them in the same way. So we're just going to focus on the way we're going to deal with tax on this project, and we'll just look at the first year to illustrate the approach that you might use. We're told that capital allowances are available and that corporation tax in Ireland is 12.5%. We're going to assume that when the profits are remitted, you have to pay the extra, the 15.5% extra, and that's the difference between 28 and 12.5. We're going to assume that that's paid in the UK. The exchange rate is forecast to be 1.5 euros to the pound. Okay, let's work through a solution here. Okay, so in year 1 we pay tax in Ireland at 12.5%. So that's going to be tax of 125. We then save some tax because we know we've got 100,000 of capital allowances, which will save us tax at 12.5%. So that's going to be 12.5. That will give us post-tax cash flows of 887.5, and then dividing by 1.5 takes us back into pounds. Now we've got the important bit, we pay extra tax in the UK. The extra tax will be paid on the pre-tax profit, and the pre-tax profit is the 1,000 that we made, net of the capital allowances of 100. So that's 900, and we have to pay the extra 15.5% in the UK. So that's going to be a tax payment of €139,500. Then dividing by 1.5 to convert it back into pounds gives 93,000. And it means that after 1 year of our project, our post-tax cash flows in pounds will be 498.7. Which is correct, and that would be for year 1. We then have years 2, 3, 4, 5, however many years ahead we were doing an MPV for. This is a correct method, but it is quite slow. It's interesting to note that there are some quicker methods. So for example, if you're ever pushed for time in an exam question, you could simply state that ultimately the higher rate of tax will have to be paid and just do the analysis at the UK rate all the way through. So we pay tax at 28%, we get the capital allowance at 28%, and if you divide through by 1.5, you get the same answer. Alternatively, if you're pushed for time, you could pay the extra 15.5% on the post-tax profit. In the exam, you'll get recognition for just showing awareness that the extra tax has to be paid. So if you're pushed for time, use a shortcut approach. A final complication that you may have to deal with is a situation where you've invested overseas and the government starts to stop or to delay dividends being paid from your overseas investment. You may need to analyse exchange controls and their impact on NPV, and we're going to do that in lecture example 8. It's more likely that you'd simply be commenting on this issue. In lecture example 8, we're looking at a company that's considering a joint venture. A joint venture is a sensible way of sharing risk with overseas investments and utilising the expertise of local companies. Here we're told that as our part of the joint venture we'll put in £2.2 million, and the cash flows that we will get, so this is already our 50%, are given in Central European crowns, and they're forecast ahead for the next 3 years. The exchange rate is moving quite quickly here, and we can see that the pound is forecast to get stronger, to almost double. This is going to be very difficult for us, because that means that the Central European crown is forecast to get dramatically weaker. In the requirements, we're asked to calculate the NPV under 2 assumptions. In both cases, discounting is our UK cost of capital of 15%. In assumption 1, we're told that exchange controls might come in, which mean that any dividends above 50% of annual cash flows will have to be retained in the European country, earning no interest, for the first 2 years of any project. The second assumption assumes no exchange controls. Let's just think about what's happening if exchange controls are brought in. This will mean that in the first 2 years we can only remit 50% of our cash flows. So 5250 will be remitted, and 5250, the other half, will be remitted in year 3. Similarly, in year 2, only half of the cash flows will be remitted, and the other half will be remitted in the next year. So that's going to mean that the total cash flows are going to be 5250 in year 1, 8000 in year 2, and all of this lot together in year 3. So it's the same cash, but it's received later, and crucially it's received at a much worse exchange rate. And what we're going to see is that if exchange controls come in, it's going to be very difficult to justify this project. Okay, let's just have a look at the solution here, because the numbers are fairly straightforward once you've got a feel for what the cash flows are. So with the cash flows profiled in the way that I've explained, at the exchange rates that are given and discounting at 15%, we'll have a negative NPV. And this would suggest that if we think that there is a good chance of exchange controls being brought in, we shouldn't go for this project. However, if the exchange controls aren't there, then the project is going to look good. So if there are no exchange controls, we get more cash up front, and not only is it received quicker, but at better exchange rates. And so when you work it through, the NPV is positive. As we said at the start of the chapter, this is a very important area for you to feel confident with. It's important that you can analyse 2 different ways of appraising international investments. It's also important that you can comment on the risks and how they might be managed, in particular political risk and translation risk, and that you know those terms. You also need to be comfortable with the complications, in particular double tax relief, that we dealt with in section 3. This is an area that you cannot do enough question practice on, and we're now going to work through one of the questions from the back of the course notes, and this is shown as an appendix to this presentation. In question 10, you're looking at a UK-based company thinking of buying a factory in Europe. We're told that we use a cost of capital of 12% and that buying the factory would cost £2.5 million. We're then told the contribution has already been inflated in euros. We're told finally that the tax rate in Europe is 20%, but in the UK it's 30%. And then at the end of the question, we've got the contribution that we currently make on exporting to Europe, and we're going to lose this as an opportunity cost. I'd like you to have a go at the calculation, assessing whether the factory would be acceptable to Presley. Because you're given the exchange rate and the inflation rate, I'd like you to use the approach to overseas investment appraisal that involves forecasting the exchange rate and converting everything into pounds. So I'd like you to pause the presentation there and have a go at this. Don't worry if you've made a few mistakes with this question. You're bound to with the early stages of question practice. But one of the key points here is that the exchange rate is given to the euro. So the euro becomes country A. So when you're forecasting the exchange rate, you need to be multiplying by 1 plus the inflation rate in the UK over 1 plus the inflation rate in Europe. And that will give you the correct forecast for the next 4 years. You also need to remember that if you're working from euros and then converting to pounds, with this exchange rate, you need to multiply to get into pounds. Don't forget the lost contribution given in the question, net of the tax that you would have paid on those profit figures. Finally, we've got to be able to deal with UK tax. And showing the workings for year 1 on our contribution in euros, we're liable to pay UK tax at 30%, but we've already paid European tax at 20%, so the difference which we're going to pay, and that's probably the only number I'd have calculated, will be the extra 10%. Converting that at the forecast exchange rate, so multiplying by 0.6135 gives 85.9. And I've rounded that up to 86 in my MPV. Apart from that, we're just going to net off and discount at 12%. Note that you could have chosen the shortcut approach and simply taxed at 30% to start with. That approach is also shown in your solution.